market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and we're seeing another big retreat in technology stocks with the spectacular rally in chip makers beginning to stumble. Now, all of this is coming ahead of the U.S. payrolls report for June, due early because of a public holiday. But first, the Fed Chair, Kevin Warsh, struck an optimistic tone for the U.S. economy while speaking at the ECB forum in Sintra yesterday, dampening speculation of a rate hike this year.
I do want to say, at least for the United States, this is a time of huge opportunity. And if the Fed can deliver on its remit to deliver prices, I've never been more optimistic about what the growth engine of the U.S. could produce.
Now, to talk more about this, we're joined by Paul Donovan, Chief Economist at UBS Global Wealth Management. Paul, always great to speak to you. So when you look at inflation, I mean, central banks started from a different place. Inflation is playing out differently. But everyone's looking at hiking. What do you think the Fed will do?
I don't think they're going to hike. I don't think they should hike. Now, there was much in Warsh's comments yesterday to disagree with. But the fundamental fact is the United States is not seeing second-round inflation effects. There's nothing Warsh can do about the price of oil. There's no way that the Fed is going to suddenly magically come up with a solution for the Strait of Hormuz. So there's nothing they can do on the oil price. But what they're not seeing is any inflation pressures in the areas they do have influence. We're not seeing a wage price spiral. We're not seeing particularly profit-led inflation. So the Fed is supposed to look through the oil price shock and say, you know what, we're going to get past this and we don't have other inflation pressures coming through.
So, Paul, do you not worry about second-round effects from this energy volatility?
I don't at this stage. The labour market in the States, it strikes me, is not strong enough to create second-round effects. Now, back in 2022, we had a bit of this. Not a huge amount, but there was a bit of wage price pressures. Because you remember, after the pandemic, everyone's had a midlife crisis. Everyone's changing their jobs. There's chaos and churn in the labour market. Well, no one's doing that now. We've settled down. So I'm not looking for the wage price pressures to emerge. Profit-led inflation is always an issue. That's when companies raise prices because of the oil cost increase, and they've certainly done that, but then they add a bit more on top. But again, with the political focus on inflation, with the sheer anger of consumers at price increases, I think it's unlikely companies are going to try and get away with that either. And at the moment, when we look at the underlying inflation pressures, be that in Europe or the United States or the UK, we're just not seeing them.
Paul, overall, and I want to talk a little bit about the ECB and I guess their conundrum, but what makes you feel uneasy about the economy? I know, we've had some good margins, we've had some good earnings. It feels like we've gone through the, tariffs and trade and even what's happening with oil, and we're okay. But what's the next thing we should worry about?
Well, the reason we're okay is that developed economy consumer balance sheets, the household stock of savings, the savings rate, they were in a pretty good position at the start of this year. And what has happened with the tariffs in the United States, the tariffs are passed on to the consumer doesn't cut back on spending. And they don't cut back on spending because they are reducing their savings rate to pay for the higher prices. And then what we saw in the States with the tariffs is now being replicated in the developed economies with the oil price increase. Consumers are basically maintaining their spending, maintaining their standards of living by scaling back on savings rates. That's not a problem. The savings rates are supposed to be a cushion that acts like this. But it does perhaps leave us a little bit more fragile at the end of this process. So it's not that I'm worried that there is a smoking gun somewhere. There's not something which is going to tip us over into the brink. But we have reduced some of our insurance over the course of the shocks that we've had this year. And so if something else comes along, if we get another disruption coming along in the future, then we're a little bit less able to weather another storm.
Paul, you also put out your UBS Global Wealth Report for this year, and inequality is deepening. So I guess the wealth overall, global wealth is growing. But what does that mean, again, for possible market events? I don't know whether we should worry about the debt now instead of in 3 years.
So I think with regards to wealth, I mean, it's important to note that wealth is growing for everybody. But what happens, of course, is that the distribution of wealth will shift according to the performance of different asset markets. Now, to be oversimplistic, the typical investor has most of their wealth tied up in real estate. But higher wealth investors tend to have a lot more of their money allocated to financial assets and in particular the equity market. So when you have periods where real estate is outperforming financial assets, then it looks like there's more equal wealth because the typical investor benefits more and the high-end investor proportionately benefits less. But when, as we've had in the last year, you see the equity markets outperforming, you create a different situation. One of the points about wealth and debt, though, and this is an important one, we hear all this anxiety about debt levels are too high and debt levels at records. Well, firstly, government debt levels are nowhere near records anywhere. We don't have record levels of debt. We have higher levels of debt, but not record levels of debt to GDP. But debt to GDP is the wrong way to think about it, because what we do have a record level of is private wealth. And the debt-to-wealth ratio is really the gauge of how easily an economy is going to be able to finance its government debt. And so because most economies have actually got quite low debt-to-wealth ratios, the UK, European countries are around about a 20% debt-to-wealth ratio, that's a very manageable position. And even a country like the United States, which undoubtedly has issues with debt, its debt-wealth ratio is still below 30%. So that's an indication, I think, that we shouldn't be panicking about debt. Certainly observing it, keeping an eye on it, but it's not a reason to panic.
Paul, stay right there because we'll talk a little bit about tech now. Bloomberg understands that Apple is in negotiations to buy chips from two Chinese semiconductor firms, which are currently on a Pentagon blacklist. Now, the tech giant is said to be seeking the chips in order to reduce the impact of a global memory shortage. Of course, that's forced it to hike prices. Well, let's bring in Ross Matheson, our chief Asia correspondent at Bloomberg. So happy to have you in London, Ross. It's nice. So how could this deal actually play out with the Trump administration?
Well, it's very interesting to see this happen. Obviously, Apple is, like other companies, suffering with this memory chip shortage that we're seeing and trying to find ways around it. But these are two companies that are on the Pentagon blacklist. That means that the Defense Department thinks they have some kind of ties to the Chinese military. I mean, it doesn't legally stop Apple from doing business with them, but the optics can be complicated. So you have hawks in the administration saying, hang on, you can't do business with these companies. I mean, Apple is obviously attuned to that reality. It seems like Tim Cook himself is taking the lead on this, including outreach to Scott Bessent in the administration. And the argument there will be quite simply, we need to make sure we don't have to keep raising prices. And we want to keep prices down. Therefore, for now, we need to source from these companies because their other suppliers, the big ones in Korea, are looking to build more capacity in the US, but that's going to take time. So they're going to say, well, right now we need to do this in order to keep prices down. And that's a message that's probably pretty good for Donald Trump, of course, thinking of the US consumer going into the midterm. So that's probably the argument they're going to make.
Ross, we also have this potential 5% stake in OpenAI for the Trump administration. So what's in it for Sam Altman?
Well, it's interesting because he has apparently floated this also since last year, the idea of some kind of stake for the US government and perhaps roping in some other companies who may not be that willing, including Meta and Google. But it's part of that awareness of that narrative that's building, not just in the US, but around the globe, which is there are some groups that stand to benefit hugely from AI, make an awful lot of money from AI, and there are others that don't. And how do you ensure that you're kind of spreading that wealth around? I mean, AI companies talking about $1 trillion IPOs, big business in data centers. How do you share that out across the country? And Donald Trump will also want to demonstrate again that he's helping share that wealth out in the US. You've got that debate in Korea about it too. How do you distribute the profits of AI? And so Sam Altman obviously is attuned to that narrative and wanting to stay again on the right side of the government, on the right side of voters.
Ross, thank you so much. Ross Matheson there with the very latest in some of these big tech stories. Let's also recap another Bloomberg scoop on tech. tech, and this time on Meta. We understand that the company is developing plans for a cloud infrastructure business that will sell access to AI computing power and models. Now, it would set up new competition with industry leaders like Amazon Web Services, Microsoft Azure, and Google Cloud. So let's get back to Paul Donovan to talk more on tech. Paul, where do you have tech in terms of things that we should worry about? I know we talk about valuations, but it just seems like even the U.S. consumers dependent so much on this capex and stocks going up.
Well, the average U.S. consumer is not actually that dependent. Wealth in the United States, when it comes to equity wealth, is very concentrated into sort of the top 10% of the population. So the average consumer has actually been far more resilient because of cash in the bank. I mean, good old-fashioned savings accounts, rather than necessarily, the gyrations of the equity market. That's been a rather focused story. Now, the capex story has affected the GDP numbers. That is certainly true. But what we've got to remember again is for the average American, they're not necessarily getting the benefit of this. I mean, it's the case that most Americans, in fact, the overwhelming majority of Americans, live in a European economy when it comes to their experience of economic growth and to their experience of economic momentum and living standard change. The headline GDP number has been flattered by these positions with tech investment and so on. The slight concern I have about the tech investment story is there is a certain amount of evidence that this is cannibalizing other forms of investment. So under President Biden, there was a real boom in factory building in the United States. I mean, we were seeing levels of factory building relative to output that we haven't seen in 40, 50 years. And that's really rolled over. Now, that might be because of policy uncertainty, for example. But I think that even if you want to build a factory in the States today, you can't, because everyone's down the road building a data center instead. And so that perhaps has some medium-term implications about the traditional side of the economy, which isn't going anywhere, but perhaps has been a little bit under-resourced as we all try and play with the nice shiny new toy of AI.
Paul, so interesting as ever. I really want to see you again very soon for more thoughts on tech and AI and, of course, inflation. Paul Donovan, Chief Economist at UBS Global Wealth Management. Now, coming up, the Chief Executive of Robinhood tells us why he believes retail customers are ready for perpetual futures and AI crypto trading. We speak to Vlad Tenev next, and this is Bloomberg. Welcome back, everyone. Now, the trading platform Robinhood believes it can overcome a lack of European interest in retail investing with an overhaul of its trading platform. Now, the firm is rolling out perpetual futures tied to commodities, exchange-traded funds, and, of course, currencies, really to capitalize on the rise in round-the-clock trading. Well, Vlad Tenev, the chief executive and co-founder of Robinhood, is here. I love this. It's like our annual get-together, Vlad, to try and understand what's on your mind and what you're working on.
I love it, yeah.
Why is Europe so behind?
Well, I think a big part of what we try to do is we're all about ownership. So there's no question the world is a very unstable place right now. And we believe that a future where only the few are owners is very unstable as well. So what we're trying to do is make everyone an owner, because we think broad ownership of equities, of other productive assets, is essential to a society that's free and prosperous.
But I guess historically, right, the UK and Europe have really struggled to get retail investors investing in stocks, full stop, compared to the US. Do you see that changing?
I do. I don't think that the U.S. had broad ownership from the very beginning either. I think if you look over the past 40 years, there have been several events that actually caused inflection points. So right now, about 2/3 of individuals in the U.S. have equities. And if you look back at what actually drove that, the employer-sponsored 401k was a huge increase, and that took ownership from 20% to something like 50%. And then it plateaued a little bit around the global financial crisis, but then Robinhood went live. And since the launch of Robinhood, we took it from 50 to right now where it is 66 and still rising. So in the UK, you have roughly 1 in 6 individuals owning stocks. And I think you can think of it as similar to where the U.S. was, 30 to 40 years ago. So there's no reason why the same things wouldn't also work here.
So it's not like culture? Or does regulation need to change in the UK?
I mean, culture certainly has an impact, but I think we can compensate for that by making it easier for people to create ownership and have that by default. So, for example, one of the other things we're working on in the U.S. is the Trump Accounts program.
Yes.
And that's ownership from birth. How can we make every newborn from age 0 by default an owner in the great companies that make up the economy? And I think when successful, that should push us up to north of 90%. And I think not a lot of people understand what buying a stock is. It can be complicated, and so more and more options where it just happens for you by default. Yeah. I think is the solution to get to really high ownership levels.
Would that ever happen in the UK?
I think there's interest. Obviously, the UK has challenges, right? There's fiscal challenges that need to be overcome, but I don't think they're insurmountable. And I've had a lot of conversations. Every time I'm here, I get to chat with members of government, folks in industry, and everyone's talking about equity participation and how to push it up. So, we can do a lot. I think the UK hasn't had its Robinhood moment in a sense. We're a very young company here. We've just launched here, 2 years ago, and the big incumbents are charging commissions on investing. So I think it's still too difficult for normal people to use these products, and we're coming to change that.
Vlad, are you having any conversation with regulators? Again, often you have an idea that Europe, it's not that it overregulates, but it's just afraid of taking too much risk because the regulators are under a lot of scrutiny.
Well, maybe I would separate the UK from Europe broadly, because yesterday at our event, we launched tokenization in over 120 countries. So oddly, on the crypto side, Europe has established frameworks that are probably even a little bit ahead of where the U.S. is right now. I mean, the U.S. has the Clarity Act, and that's in process, and the Genius Act passed, so we're making steps. But EU has, markets and crypto assets regulation. There's an established framework to work through. With the UK, we have ongoing constant conversations with the FCA and with other regulators. And we've actually found a great deal of openness to innovation. And I think every market, particularly mature markets like the US and UK, have to balance new innovations with the fact that big institutions and retail investors count on stability and security. And that balance isn't an obvious one, but I think they're making a good effort and really thinking hard about how to solve these problems.
Is there one thing in the UK that would encourage retail investors to get involved more?
I mean, I think that if you look at what's worked in the US, sans Robinhood, having a little bit more emphasis and power behind the employer-sponsored plans, I think that would move the needle. Whenever I talk to people who work here, I don't know if you would agree, but they all say the employer-sponsored retirement offerings are lacking. You never really know what you're being put into. It's a little bit opaque. They're difficult to use. So I think there's a lot of opportunity there. And again, that took participation from 20% up to north of 50. So it's been incredibly successful.
Vlad, you've been very optimistic on AI. What's been the biggest change actually in your world that you're now able to do thanks to AI?
I think in our world, the biggest change has been that these AI tools, agentic platforms, have made it easier to write software. Yeah. If you think about software, it's really the engine to make products. And so writing software used to take a lot of manual effort. You would have to write it all by hand. And then, of course, the tests can be cumbersome to make sure everything works. You have to write that by hand, too. And these agents, because they're trained on the entire corpus of publicly available code, and also it's easy to create environments where they can, run the code, execute it, test it. That's gotten very, very good. That's been further ahead of most other use cases. So you're seeing automation of the field of software engineering, which really drives the economy and the IT industry. That's just gone through the roof, and we've benefited from that, and we're also trying to give that to our customers with our agentic trading products to make it as easy as possible to create trading strategies.
I mean, do you think, I guess SpaceX and some of the other big Anthropic IPOs, does it also capture more of the imagination of retail investors? I mean, do you see a bump of people saying, well, actually, everyone's talking about it, it feels big, it feels exciting, and we want to be part of it more?
Oh, absolutely. I mean, I think there are issues, though. I think the biggest issue is you look at these companies, SpaceX, who recently went public, Anthropic and OpenAI, or either later this year or early next year. These companies are going public at valuations in the trillions. Yeah. So we're a long way away from Amazon and Microsoft, where a retail investor could get in at the IPO at valuations in the hundreds of millions and then see a 1,000 or 10,000x return in the public markets. So I think that's actually the biggest problem that not a lot of others have realized, right? And we're trying to attack it from two angles. Number one, make it easier for companies to go public, change the brand of being public so that it's less of like a chore and more, make it seem more fun, right? If companies constantly talk about how terrible it is to be public, the entrepreneurs who are getting started won't have that aspiration. Right. Yep. And when I started my career, being public was like a cool thing. So I think it's a bit of a change now over the last 10 years. I think the other thing is just giving retail exposure to these private companies. But
do you worry about a bubble? I mean, is that a day of reckoning? Actually, if there is some, a bubble collapse in AI and people get burned?
I mean, I don't really worry about bubbles happen, right? And not to say that AI is or isn't. I think that AI is a little bit of a different shift because these companies are generating significant revenue. So, unlike some prior bubbles where, the revenue doesn't match the valuations, I think that the revenues are just increasing at an exponential rate. So there is substance behind these companies for sure. They make products that enterprises and consumers use. And then you look at the market, and there's always fluctuations. We've been through 3 or 4 bubbles over the past few years, and the investors keep buying. They're investing for the long term, and it's ownership is like a multi-decade game.
Vlad, thank you so much for joining us, and congratulations on everything that you've launched also in Europe. Vlad Tenev, Chief Executive and Co-founder of Robinhood. Coming up, but don't miss our interview with Jim DeMare, the Co-President of Bank of America. We discuss the outlook for rates, deal making, and of course the wider banking sector. Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. A global sell-off in chip stocks reignites concern that the AI rally may have gone too far. Fears of a supply glut are also fueled by a Bloomberg report that Meta is planning to sell computing power. Investors look ahead to U.S. jobs data, of course, after Kevin Warsh, the Fed chair, says price pressures have eased. And the U.S. says more oil is flowing through the Strait of Hormuz, with signs of progress between the U.S. and Iran over peace negotiations. So major central bankers at ECB's annual forum in Sintra have shared the view that there's no need for aggressive rate hikes following the conflict in the Middle East. Well, among them, the Fed chair, Kevin Warsh, who was making his first international public appearance since getting the top job.
We've all looked around and we've seen that prices are too high, and I don't think I'm the only one on this stage that's recommitted to deliver price stability.
I think risks, by the way, that we have to the upside on inflation and to the downside of growth are probably more broadly balanced than they were a few weeks ago as a result of what we're seeing.
It is very frustrating. I was very much of the view that we were going to have inflation back at the 2.0 targets, in the late spring.
There's a lot of uncertainty out there. Those risks could shift quickly. And the other part of our message is, if the situation changes, we're prepared to take action.
Well, beyond monetary policy, there's also renewed concern about AI capacity oversupply following our scoop on Meta's plan to sell computing power. So investors are increasingly worried that the breakneck pace of financing tied to the data center boom could sow the seeds of the next market shock. Well, to discuss all of this and much, much more, I'm delighted to be joined by Jim DeMare, co-president at Bank of America. Jim, great to speak to you.
Great to be here.
I mean,
Good morning.
There's so much to talk about.
Yeah.
When you look at the world, I mean, there's all these forces and a lot of uncertainty.
Yes.
But where do you see the opportunities for Bank of America?
Generally speaking, as even though it's Bank of America in the name, we are global. We have a global franchise, particularly in our institutional and corporate businesses. So, we've talked about through our investor day, which we had in the fourth quarter, we do see considerable growth opportunities internationally. Most of that comes in our corporate and investment banking and our markets business. And, based on closing out the second quarter, we're, well on our way to achieve those goals.
What are you spending most of your time on? Again, given, we talk about inflation, we talk about central banks.
Yes. So there's no shortage of things to spend time on. If you look at, I was asked to take on this new role with Dean last fall. We're a large company, a lot of things to do. I spent my career, obviously, in the markets business, and as a result of that, closer with banking. But, when Dean and I look at it, we just have an incredible platform with incredible opportunities. And our it sounds maybe too generic, but bringing the capabilities we have as a firm together to deliver for whether it's institutional clients, corporate clients, individuals, it's the consumer business, our wealth business, and bringing it all together, it's pretty powerful. That's what we're spending our time on.
Jim,
in addition to,
you've had quite a year, right, since taking on that role.
Yes.
Just because of the massive IPOs out there, valuation, AI, and then everything that's happened with energy price.
Yes.
What's your take on AI right now?
Take on AI, it's the biggest debate. Are you utopian, dystopian about what the outlook is? And that's just on what the technology can positively do or negatively impact society. And I think, like much of this, it's going to be an ongoing discussion, and no one really has an answer yet today. Not dissimilarly, I think the same for the discussion on, is there too much commitment being made and too much CapEx?
No.
I think it's nuanced, but if you look at the number of deals that are discussed in agreements that people say they've reached relative to the number of shovels in the ground, there's quite a large disparity. So I don't know how, with that construct combined with the fact that you have constraints on everything from energy to materials, maybe a little bit less so chips constraint today as more companies have gotten into manufacturing. The demand far outstrips the supply, and it's not overcapacity in terms of what's built yet. Are bad projects going to be done? I'm sure. Are great projects going to be done? Of course. But I think it's going to take a few years for us to determine, is the impact really there with AI? Is the CapEx spend worth it? And has too much been built?
What do you see in the U.S. economy right now, given all the CapEx and, of course, the AI?
It's a meaningful contributor to growth in the U.S. Obviously, you think about the large projects themselves, but then you have to think about local suppliers and businesses that are supplying to those larger projects. So there is a cascade effect that happens. Inflation numbers have been coming in a little bit softer. Expectations are, with oil prices coming down, that we're going to see a drop and a move closer towards the 2% target that's been discussed. We're still obviously north of 3%, so there's a way to go. But as we were talking about before we went live, Kevin Warsh was on yesterday, and he was optimistic. I think for all the fears that whether he was going to communicate or not communicate, he was pretty communicative on what the objectives are. I think he's just stuck to, we're just not going to talk about it daily.
Jim, when you look at the IPO, I mean, so we have these massive
Yes.
companies that are IPOing. I was speaking to Vlad Tenev of Robinhood, and he says, when he IPO'd, it was like North Star of IPOing.
Yes.
I mean, do you still feel that with clients, or is it just the big ones that want to IPO?
We're gonna if the year annualizes where we've started, I think we'll hit numbers of roughly 3 times where we were previously or last year. If you look at the equity capital markets activity, just generally speaking, so thinking about block trades and other activity that happens in equities, that's up roughly 75% from where we were last year. There's definitely a theme of greed over fear at the moment. So people see both institutional investors and retail see what returns and wealth has been generated, and I think it's a difficult thing to ignore. Now, all that being said, I like to use the analogy of if you look at the indices, which is obviously what everybody sees every day, is the benchmark. Particularly for the S&P, it looks relatively calm on the surface. I like to say like a duck, but underneath there's a lot of paddling that's going on, and there's a lot of rotations, in and out of sectors. And there's been a lot of talk about tech has been the driver of performance, and that's where we stand today.
So what are you expecting for M&A and IPOs? Again, last year was a low level.
Yes.
Right.
Yes.
So I don't know whether this is like the good kind of M&A that we could see.
I think it is. I mean, if you look at what's happening, I think there's been about 2.8 trillion announced so far this year, and I think a lot of it is to enhance growth. Right? A lot of times, I shouldn't say a lot of times. Oftentimes, M&A can happen for different reasons. Sometimes someone can be pursuing an acquisition to save their business. Yeah. I think if you look at...
That's not the good kind.
No, that would not put that in the good kind. And clearly, if you look at it, it's a lot about bringing synergies and bringing scale to industries. So I think it's very constructive, and the markets are very receptive, whether it's the debt markets or the equity market. So I think it's a big positive.
What worries you the most in markets? I mean, we talk about a possible, I don't know if it's a credit event, or is there something that we're not thinking about that you're starting to worry about?
We worry a lot. And we're always trying to think about what we're not seeing. There is a lot of demand for capital. And the question is, how much higher is the cost of capital going to be as these demands keep coming to the market? So, the shock of, can we have something again come out of, China or Asia as far as a model, and can that be very disruptive to some of the Western models, large language models and other? That's kind of always out there. I think it may be a little bit more of the slow burn as people start to realize debt markets have been very constructive with base yields, sovereign yields being higher, and that being the benchmark for corporate spreads. Investors have been willing to take tighter spreads. Spreads have relatively unchanged despite the fact that base yields are up. So investors are still getting a good yield. The question is, if we need another, $2 trillion of CapEx, what concession is someone going to want?
How much are you expecting in terms of infrastructure spending? Because a lot.
The range is so wide. I mean, there are projections over the next 4 years for it to be up to $6 to $7 trillion. Maybe, maybe, but the trillion plus a year seems to be, at least for the near term, broadly defined for infrastructure, digital infrastructure, which would include not only the factories but chips and other related activities. So there's expectations that that's going to be the largest part of the investment grade debt market.
Jim, again, there's a lot of, we've been talking about private credit for a long time.
Yes.
I mean, do you see more CVs from people that are in private credit that want to get back into banking?
That's a great question. Not yet. I think that there's, and when we just had an article on it, I think it was this morning, I read it, maybe last night, but the private markets, broadly defined, are becoming a larger part of the market. So, sell-side firms, traditional banks and investment banks are, participating more in those larger investment-grade private market activities, and I would expect that to continue. I think when you get into the private credit side, we still are seeing the industry, is still seeing redemptions. Yeah. Most of it's not performance related. people are just looking for liquidity and would like their money back. And, I think that's going to continue to play out for a bit.
Jim, at the start of the interview, you said, look, Bank of America is not only about America. So where do you see the biggest growth coming from, actually, by region or even by country?
Yeah, if you look, region's probably best, and candidly, Europe and Asia is where we've been investing and we continue to invest. Yeah. So, as you see with, Asia's on the forefront of much in the technology space, and that's obviously an area that we're heavily focused on. And, we've been in Europe for, a long time. And I think as Europe is looking to grow and, infrastructure and other, related activity, we've been participating in that to the extent that it's been happening. And I think that there's a little, we just need a little bit more kind of energy for growth, I think, in Europe is what, I spoke to a handful of CEOs this week. And while many can say, maybe the U.S. is too optimistic, I felt it in Europe or just in the UK this week, and speaking to UK and European CEOs, it was a little heavier. Yeah, than I anticipated, or more than it was 3 months ago.
Is that because of access to capital, or is it because of politics, or just
I don't know. I don't know, but it was quite surprising.
You're one of the sponsors for FIFA.
Yes.
Is that exciting? How exciting is that?
That's pretty exciting. It's great for branding. The enthusiasm is incredibly high. It's exciting.
Yeah. I was in Sintra with a lot of central bank governors, and all of them would say, wait, my team's playing. Now I need to go. It really kind of brings people together.
No, it really does, and that's been part of our, Bank of America. We're very philanthropic. We've been very engaged in sports, in philanthropy in sports, and we have David Beckham, working with us and supporting. But we strongly believe that sports brings communities together. So what's better than, sponsoring, great activities and bringing people together? It's a great thing to be part of.
Everybody loves the World Cup. Just don't call it soccer. And are you Team USA?
I have to be. Well, Italy didn't make it again, so.
We don't talk about that.
I'm sorry.
Jim. We definitely don't talk about that next time.
Sorry.
Thank you for
Wonderful.
joining us.
Yeah, thanks for having me.
Jim DeMare, they're co-president at Bank of America. Now, coming up, how AI is helping to drive growth at Grindr. So we speak to the chief executive of the dating app to talk about some of the challenges, but also opportunities ahead. That's next, and this is Bloomberg. Welcome back, everyone. Now, across trading desks from Hong Kong to New York, the wild ride in South Korean stocks has definitely become a hot topic. And the explosive growth in the leveraged ETF is reshaping trading in one of the world's most closely watched chip stocks. Well, Charlotte Yang, our Asia equities reporter, joins us from Hong Kong. Thank you for joining us. So tell us a little bit more about this fund and why it's become so important to share price moves in chip maker SK Hynix.
Yeah, so this product listed in Hong Kong in October, in just a couple of months' time, has quickly become the world's largest of its kind. The CISO of SK Hynix leverage product now has around $13 billion in asset under management. So the product is built off on one simple promise, which is to offer investors 2 times daily performance of SK Hynix shares. But because of its size, and to deliver that promise, what they have to do is that they have to go through a rebalancing process every afternoon. And because of its size, along with some smaller product, on volatile days, their rebalancing flows can account for 60% of SK Hynix turnovers. So essentially, we've got into a situation where some traders would call a tail wagging the dog, that these products and derivatives based off SK Hynix that was meant to be merely tracking it is actually now influencing the shares.
So, Charlotte, what sort of risk does this actually present to broader markets?
Yeah, so if you think about how big SK Hynix position is for Kospi, for example. It now accounts nearly 30% of Korea's equity benchmark. The stock itself is also so central to the role, too central to the global AI trade this year. So this feedback mechanism, which, the rebalancing of this product, they have to buy into the rally and sell into declines. People are worried about what happens when we see a big down day in SK Hynix, and you have these mechanical flows that will exacerbate the selling. I think that's what a lot of people are worried about. Also, this product is built off a large ecosystem. The product counts more than 20 counterparties in supported running, including many of the Wall Street firms. And we're also seeing some of the strats showing up in the mechanics there. For example, the banks that offer the equity swaps to manufacture these 2 times exposure to SK Hynix, they're now facing some funding capacity constraints, also rolling back some of that exposure and charging clients higher prices for that. The banks, they have to find out ways to hedge for themselves. And hedging for these kind of sharp declines as the Hynix also come up, the pricing for those exotic derivatives. So this really is a very complicated ecosystem around the product, and the kind of mechanical flows people are worried about on what happens on a big down day.
Charlotte, thank you so much. Charlotte Yang there on this morning's Big Take. We're also pushing it on social media. It's a great read that everyone should go and check out. Now, social networking. I'm losing my voice, and it's only Thursday. Social networking and dating app Grindr has raised its revenue guidance for the year to at least $535 million as it banks on artificial intelligence to boost growth. Now, company says users are spending more time on the app, reporting higher satisfaction rates and encountering fewer technical issues, thanks in part to the incorporation of AI. Well, George Arison, the chief executive of Grindr, joins us now. George, thank you so much for joining us. So I want to talk about AI in a second, because you've described Grindr as an AI company, but actually you're also partnering with Madonna around her new album release. I mean, there's a concert. How did that partnership come about, and is this the first of many partnerships?
Yeah, it was a really awesome summer for us in that regard. So Gaia Seri, her manager, sent me an email something like October, November last year. I got the email. It was from a Gmail account. I thought it was some Nigerian prince emailing me first, but we figured out that it was actually him, and we met in December, and he basically said, look, she's going to be launching this new album, and she knows that gay men are kind of her prime audience, which is correct. Gay men love Madonna, and we'd love to partner with Grindr to launch it, and so it was very much a partnership made in heaven in some ways, like a perfect match. And we ended up taking over Times Square, as you're now showing on the screen, a few weeks ago, and it was a really great concert.
So, George, what does it tell you about how the brand has really evolved in the last couple of years?
So when I got there, we didn't have a brand strategy, and what we've come up with is that Grindr is a global gayborhood. It's an app that people use to connect to the gay community anywhere in the world. And yes, those of us who get to live in big cities have to have a gayborhood locally, but most people actually don't have that, and Grindr offers that to you through the digital world. And through that, you use Grindr in many, many different ways, whether it's for a hookup or for a relationship or just to have fun. And that's what we try to show people through things like what we've done with Madonna.
But so you're also expanding it, right, beyond dating into commerce. I mean, you're talking about, hotel offerings or even finding gay-friendly healthcare providers. So what's your bigger vision for the platform?
The bigger vision is to be the super app for gay men, where people come and get all the different things that they might be buying from many different providers, actually from us. So in the U.S., we already offer Woodwork, which is our performance medications brand. It offers ED medications, GLP-1s, testosterone, other types of treatments. We'll be expanding that into healthcare for sexually transmitted diseases as well over time, and then eventually clinical care as well. So I think Grindr Health actually can be a huge vertical for us over time, because gay men do very much care about their health and their wellness. And yes, we're going to be offering people the ability to be able to find the right hotels eventually as well. Not yet, but that's kind of on the roadmap too.
So when you say over time, like how different will Grindr be in 5 years?
I think it's going to stay very true to its core, because the things that make Grindr great, which is its deep connection to gay culture and the ability for people to connect, always needs to be there. If we don't do that very well, then people won't come to us. But then on top of that, we want to layer on many other products and services that people are buying from us, and really capturing a bigger part of people's wallet.
But looking 5 years out, how does AI change the way people meet, date, and build relationships?
Most things around dating are very location-based. That's historically how it's always been. But that actually is a huge limitation, because in most places, gay men don't actually have a critical mass of people to interconnect with because there's so few of us. And AI can really change that, help you find the right partners anywhere, and give you the transparency on information on why that connection makes sense. And in that world, then people might be much more willing to take a risk on distance that they otherwise might not take today.
You've described Grindr as an AI company. What do you mean by this? And actually, what does it actually change, I guess, user experience?
So it's both from the user experience perspective. We now are building a ton of features that make recommendations, connections very different from what we've had before, and people are already seeing that in the app, but also in how we work. I mean, our engineering team today is producing an equivalent of like 300-person engineering teams work with only about 100 people. And that's because they're using AI to code. We've been very far ahead of most companies in adoption of AI coding, and productivity has skyrocketed as a result, which allows us to build a lot more things and to make the product a lot better for people, which is awesome.
But, George, so this is premium tier. So how's it different if you're a premium tier compared to the normal
So
user?
most of the user features are on the premium end for AI, obviously from the engineering team's perspective, it's for everybody. But over time, the things that we offer premium users will be offered to everybody. Already on Grindr, if you click on one profile, at the bottom of that profile, you'll see 4 recommendations of profiles like that one. That's all through our native, like, internally built models that previously we couldn't offer you. And the accuracy of them is really incredible. We actually give you insights on users now as well, not in Europe yet, because GDPR is pretty complicated here. And so we haven't yet enabled some of the AI features in Europe, but in the US, you already get insights about people that are all through AI, which are also pretty awesome. And hopefully, over time, we can bring those features to Europe as well. It's just more complicated here because the regulations make it a lot harder to actually innovate.
I mean, agentic AI means, you know, that we'll each have agents. How does
Yes.
that change personal-to-personal connections?
Well, I think personal connections are going to be more important in that sense versus less important. But we also know that there's a huge epidemic of loneliness in the world. And in that sense, people who do talk to agentic synthetics actually feel better and are less depressed than those that don't. There's a lot of data to support that. And so we certainly are not opposed to that. And if we can facilitate that, we will. But I think personal connections are going to be more important in a world that we're going to versus the one that we're in today.
So, George, I mean, you know, have a very clear idea of what you want Grindr to be and some of the milestones. What do you have as priority over the next 12 months to get into that framework that we talked about 5 years from now?
So, number one, we've been building a lot of these features for a while now, but users have not actually been feeling them fully yet. Over the next 12 months, they will see a lot more of them. Edge, which is our premium tier, is going to go live sometime towards the end of this year or early next year. And that's going to be a really big change in the app, and we're really excited about that. That is a lot of these really unique AI features brought to life to people. We've also been re-architecting the app and removing a lot of the old code that it was unnecessary because Grindr is not a young company. And that has reduced the number of bugs that people are seeing dramatically. Crash rates are down as well. But the UI hasn't yet changed, and that's the next thing that's going to change, so it's going to feel a lot better. Those two things I'm super excited about. And then our investments in healthcare are also pretty significant, and I think there's going to be a lot more on the come there as well, which I think is going to make a big difference as well.
George, thank you so much for joining us today. That was George Arison, the chief executive of Grindr. Now, tomorrow I'll be at the Aix-en-Provence Economic Conference in Aix-en-Provence, the south of France. It's been dubbed the French Davos. We'll bring you interviews with business leaders and policymakers, including Emmanuel Moulin, the new Banque de France governor. It'll be a good conversation, of course, on inflation, on the way that the world is going, but also how AI can change productivity and economic growth models for the future. Up next, it's Bloomberg Brief, and this is Bloomberg.